Check out this over here. Markets firmly expect the Fed to cut interest rates on September 18. How much do they expect? Around 25 basis points, which is 0.25%. More than that, markets are also expecting that this cut is not likely to be too big, as mentioned in the second header over there. In fact, a bigger than expected rate cut might spook the markets, telling that there could be big recession, etc., etc. Last but not least, there's a third header. Stocks don't always rise after Fed cuts interest rates. I guess this refers to general stock markets, especially in US equities. So today, I'm going to share with you where you can exactly invest, and I've prepared 4 key segments. So if you're curious, continue watching. Hi guys, welcome back. Let's start with the first segment for you to consider investments, which is into emerging market equities. The reason for emerging markets is very simple. As mentioned over here, a rate cut and a weaker US dollar would help emerging markets broadly, especially when they give higher yields and when investors look to diversify beyond US. Now, US equities has been on tear. AI has been a revolution. So global investors, whether you're in Asia, Europe or Latin America, everyone has benefited allocating towards US equities. Fed keeping interest rates high would also give the dollar strength, correct? The question now becomes, if this cycle reverses, would the appeal of US assets start to fade? And if they start to fade, where will money move towards? That's why emerging markets come into strong consideration. There's evidence that there's momentum for this already. As mentioned over here, Asian currencies have hit a 7-month high against the US dollar. And with that, improving domestic backdrop has lifted sentiment in Asia in general. Specifically, Malaysian ringgit and Korean won have been the strongest. Malaysian ringgit, as you can see over here, has gained 6% on a 1-year basis against the US dollar already, which reinforces this idea. Emerging markets tend to have an inverse relationship with the US dollar. When Fed cuts rates, US dollar tends to slide and money flows towards emerging markets. That's why the blue line is always going a different direction as the orange line. JP Morgan has actually a paper that reinforces this idea. Since 1988, emerging markets have delivered positive performance 24 months after the Fed rate hike cycle for 4 of the last 5. On average, returns have been a solid 29%, representing an average outperformance over developed markets of 17 percentage points. Certainly, the broader fundamental backdrops, US rates do play a disproportionate role in driving flows in and out of EM, and as a higher risk asset class, EM tends to benefit when US interest rate hikes are complete and global economic sentiment is improving. That's where risk appetite is high. A chart produced by them shows 4 of the last 5 cycles indeed gaining, and 2 of the cycles in green are actually more than 40%. I'll particularly focus on the 2004 to 2006 one, which gained 45% in 24 months because that is the only period that Fed was around 5+%. The more recent 2015-2018 cycle, Fed rate hike was only to 2+%, to 2 to 2.5%, which is not the same as current cycle. So the question becomes for you, if US dollar weakens and money starts to look for emerging markets, do you want to position yourself in emerging market equities? Beyond emerging market equities, let's move on to the second key asset class, which is Asian high-yield bonds. UOB Asset Management, as mentioned over here, foreigners are piling into Asian bonds and it is looking strong this year. Global investors are looking to lock in yields as US rate cuts gets more imminent. Asia has become a new investment destination amid US and Europe growth fears. Actually, Asia being a destination is nothing new, but history always rhymes. This cycle again could see Asian bonds attracting monies yet again. As you can see, these funds are paying 6, 7, 8 or even 9% dividend yield. BlackRock Asian High Yield Bond Fund pays 9.5% dividend yield. And before we start salivating over it, do note again, the underlying bonds must provide the dividend yield, correct? If not, sometimes it can come up from capital. BlackRock Asian High Yield is that blue line over there. The 3-year annualized performance is minus 10.33% per annum. If we see in terms of 2-year performance, comparing against emerging market equity fund and a low risk bond fund, you see that that blue line is extremely volatile, correct? So do note this is an asset class that can swing in value. It's not ready for capital preservation. Then if we see in terms of 1-year performance, it is very strong now because interest rates possibly are going lower. That's why the UOB report of investors moving towards Asian high yield bonds, correct? The risk reward is good, and if you'd like me to build a portfolio on this front, look for my links below. I'll value it by not only adding high yield bonds, but also building REITs into it. So again, to reach me, look for the links below. With that, let's go to REITs finally. At this moment, REITs and bonds have trended quite similarly because Fed has done such an abrupt rate hike cycle. These two are typically very sensitive because for REITs, at least for S-Reits, 30 or 40% leverage factor within the stock itself. So this over here is by UOB Kay Hian. The potential impact of this Fed cut cycle is likely positive for REITs, property-related stocks and highly geared companies. That will be the next segment, but we will focus on REITs. They've mentioned that relatively high-yielding sectors like REITs should regain their luster for investors desiring income. Many blue-chip S-Reits currently trade at an attractive distribution yield of 6 to 7%. Our biggest REIT, CICT, is actually trading slightly above 5% yield right now. As you can see over here, they are possibly the best performing big REIT, clocking in 12.83% on a 1-year basis. I've done a recent video on 7 REITs who are positive on a 1-year basis already, and I think together, all these big 7 will pull up the index, as you can see over here, which may have already formed a bottom in July 2024. I'm a big investor in the REIT space, with my portfolio now allocating close to 45% towards it because I feel it's undervalued, and I'm not the only one. As mentioned over here, REIT ETFs have seen a historic AUM growth with rising trading volumes. I think this is healthy market cycle, and right now the total AUM they manage is $917 million already, which is close to the 1 billion mark. Healthy trading volume is also very important to show that there's strong investor interest. I will be keeping tabs on the REIT space very closely, and hopefully you've taken some of my REIT suggestions recently. And if you do like such information and to show appreciation, and if you're keen to stick further on, smash the subscribe button as we march towards 60,000 subscribers and impact more investors to invest the right way. Thank you very much, and with that, let's move on to the most juicy segment, which is stock ideas. Just now I mentioned that UBK has mentioned highly geared company, which is companies who have a lot of debt on their books. A Fed cut cycle means that their interest costs would become smaller, correct? Finance costs being much easier on their income statement. So they have actually done a collation of who are companies with the highest net debt to equity and are listed in Singapore. At the top of the list is ST Engineering, followed by StarHub, Sembcorp, etc., all the way until S-Reits and Thai Beverage. I have pointed out in green ST Engineering and S-Reits because these two have increased their debt to equity because of acquisitions. I'll cover that in a quick while, and I wanted to include Thai Beverage, but seeing their latest results, it hasn't been too inspiring yet. Operationally, it's still pretty flat, in fact slightly declining, even though they are in a very solid recurring business in spirits and beers. That is why also, if you compare between ST Engineering, S-Reits and Thai Beverage, you would realize that yes, in the recent 1 month, everything has been trended up. Less interest cost is a benefit to these companies, but the operations still need to be good for stock price to gain. So Thai Beverage is still now negative, but S-Reits is up 42% already and ST Engineering up 16.67%. Let's touch on ST Engineering first, a very blue chip, stable defense company in Singapore. I've done before a previous tutorial, which I'll leave links above, and towards the end of this, and its latest acquisition is the one that caused its debt to equity ratio to spike up. And it's actually this $2.7 billion TransCore acquisition. This has brought growth to the company, which is similar to the next company, S-Reits. S-Reits also made a mega acquisition of $1.8 billion when it acquired WFS Worldwide Flight Services back in 2023. From OCBC Investment Research, they have noted that S-Reits' operating profit for the quarter has jumped to $112 million from just $7.9 million in first quarter 2024. The key reason is in margin expansion, which is very good, and there's some other synergies with its operations. I was concerned about this acquisition, but seeing how S-Reits is executing well, I think things are looking better for S-Reits. Fair value has been raised to $4.10 with profits expected to grow, and I believe more analysts will start raising its target price for S-Reits. As always, leave your thoughts in the comment sections below and check out these 2 tutorials I have, the first one being on ST Engineering and the second one being on S-Reits, covered as one of the 4 stocks in how I invest $100,000 today. Check out these tutorials and invest safely. If that's all from here, see you there. Take care as always. Goodbye.